Welcome! Today, we're diving into the world of IRAs, or individual retirement accounts. If you've ever wondered what an IRA is, or how it can help you save for retirement, you're in the right place. We'll break down the basics, explore the different types, and help you figure out which one might be best for your financial goals. Whether you're just starting your career or planning for the future, understanding IRAs is a key step toward building a secure retirement. Let's get started by looking at what an IRA actually is and why it matters. An IRA, or individual retirement account, is a special savings account designed to help you save money for retirement. The main advantage of an IRA is that it offers tax benefits, which can help your savings grow faster over time. You can open an IRA at most banks, credit unions, or investment firms. The money you contribute can be invested in things like stocks, bonds, or mutual funds, giving you the potential for growth. IRAs are a popular choice for people who want to take control of their retirement savings outside of a workplace plan. Opening an IRA is a smart move for anyone looking to build a nest egg for retirement. Even if you already have a 401k or similar plan at work, an IRA can give you more flexibility and control over your investments. Plus, the tax advantages can make a big difference in how much your money grows over the years. Whether you're self-employed, changing jobs, or just want to save more, an IRA is a valuable tool to help you reach your retirement goals. There are several types of IRAs, each with its own rules and benefits. The two most common are traditional IRAs and Roth IRAs. There are also SEP IRAs and SIMPLE IRAs, which are designed for self-employed people and small business owners. Understanding the differences between these accounts is crucial for making the right choice. In the next few scenes, we'll break down each type so you can see which one fits your needs best. A traditional IRA is one of the most popular retirement accounts. With this type, your contributions may be tax deductible, meaning you can lower your taxable income for the year you contribute. The money in your account grows tax deferred, so you don't pay taxes on investment gains until you withdraw the money in retirement. This can be a great option if you expect to be in a lower tax bracket when you retire. A Roth IRA works a bit differently. With a Roth, you contribute money that's already been taxed, so you don't get a tax deduction up front. However, your investments grow tax-free, and you can withdraw both your contributions and earnings tax-free in retirement, as long as you meet certain requirements. This is a great choice if you expect to be in a higher tax bracket when you retire or want tax-free income later on. So, what's the main difference between a traditional and a Roth IRA? It comes down to when you pay taxes. With a traditional IRA, you get a tax break now and pay taxes later. With a Roth IRA, you pay taxes now and enjoy tax-free withdrawals in retirement. Your choice depends on your current and expected future tax situation. Let's look at a side-by-side comparison to make things clearer. Not everyone can contribute to every type of IRA. For a traditional IRA, anyone with earned income can contribute. But the tax deduction may be limited if you or your spouse have a retirement plan at work and your income is above certain limits. For a Roth IRA, your ability to contribute depends on your income level. If you earn too much, you may not be eligible to contribute directly to a Roth IRA. Both traditional and Roth IRAs have annual contribution limits set by the IRS. For 2024, you can contribute up to $6,500 per year or $7,500 if you're age 50 or older. These limits apply to your total contributions across all IRAs, not per account. It's important to stay within these limits to avoid penalties and make the most of your retirement savings. The tax benefits of IRAs are a big reason why they're so popular. With a traditional IRA, you may get a tax deduction now, which lowers your taxable income. Your investments grow without being taxed each year, and you pay taxes when you withdraw the money in retirement. With a Roth IRA, you pay taxes up front, but your money grows tax-free and you don't pay taxes on qualified withdrawals. Understanding these benefits can help you decide which IRA is right for you. With both traditional and Roth IRAs, you generally can't withdraw money before age 59 and a half without paying a penalty. However, there are some exceptions, like using funds for a first-time home purchase or certain education expenses. With a traditional IRA, you must start taking required minimum distributions, RMDs, at age 73. Roth IRAs don't have RMDs during your lifetime, giving you more flexibility. Required minimum distributions, or RMDs, are mandatory withdrawals you must start taking from your traditional IRA once you reach age 73. The amount you must withdraw each year is based on your account balance and life expectancy. Failing to take RMDs can result in hefty penalties. Roth IRAs, on the other hand, do not require RMDs during your lifetime, making them a great option for those who want to leave money to heirs. Taking money out of your IRA before age 59 and a half usually means you'll pay a 10% penalty on top of regular taxes. There are some exceptions, such as for qualified education expenses, first-time home purchases, or certain medical costs. It's important to understand these rules so you don't accidentally trigger penalties that could eat into your retirement savings. One of the great things about IRAs is the wide range of investment options. You can invest in stocks, bonds, mutual funds, ETFs, and more. This flexibility allows you to build a portfolio that matches your risk tolerance and retirement goals. It's important to review your investment choices regularly and make adjustments as your needs change over time. Opening an IRA is straightforward. You can set one up at most banks, credit unions, or investment firms. The process usually involves filling out an application, choosing your investments, and setting up contributions. Many providers offer online account setup, making it easy to get started from home. Be sure to compare fees, investment options, and customer service before choosing a provider. Once your IRA is open, you'll need to decide how much to contribute and how often. You can make lump sum contributions or set up automatic transfers from your bank account. Regular contributions can help you stay on track with your retirement savings goals. Remember to keep annual limits in mind and adjust your contributions as your financial situation changes. Traditional IRAs offer several advantages. You may get an immediate tax deduction, which can lower your tax bill for the year. Your investments grow tax-deferred, allowing your money to compound faster. Plus, you have flexibility in choosing your investments. These benefits make traditional IRAs a popular choice for many savers. There are some drawbacks to traditional IRAs. You'll pay taxes on withdrawals in retirement, which could be a disadvantage if you're in a higher tax bracket later. Required minimum distributions mean you must start taking money out at age 73, whether you need it or not. Early withdrawals can also trigger penalties and taxes. Roth IRAs have some unique advantages. Qualified withdrawals are completely tax-free, which can be a huge benefit in retirement. There are no required minimum distributions during your lifetime, giving you more control over your money. You can also withdraw your contributions, but not earnings, at any time without taxes or penalties, making Roth IRAs more flexible. Roth IRAs aren't perfect for everyone. You don't get a tax deduction for contributions, so there's no immediate tax benefit. High earners may not be eligible to contribute directly due to income limits. Also, if you withdraw earnings before age 59.5 and before the account is 5 years old, you could face taxes and penalties. A SEP IRA, or Simplified Employee Pension IRA, is designed for self-employed people and small business owners. It allows for higher contribution limits than traditional or Roth IRAs, making it a great option if you want to save more for retirement. Employers make contributions on behalf of employees, and the rules are generally simpler than other retirement plans. A simple IRA, or Savings Incentive Match Plan for employees, is another option for small businesses. Both employers and employees can contribute, and the plan is easier to set up and manage than a 401k. Contribution limits are higher than traditional or Roth IRAs, but lower than SEP IRAs. Simple IRAs are a good fit for small businesses looking for a straightforward retirement plan. Both SEP and Simple IRAs are designed for small businesses, but they have different rules. SEP IRAs allow for higher employer contributions, but employees can't contribute directly. Simple IRAs allow both employer and employee contributions, but with lower limits. Choosing between them depends on your business size, structure, and savings goals. If you change jobs or retire, you might want to move money from a 401k or another retirement plan into an IRA. This process is called a rollover. Rollovers let you keep your retirement savings growing, tax-advantaged, and give you more control over your investments. It's important to follow IRS rules to avoid taxes and penalties during the rollover process. If your income is too high to contribute directly to a Roth IRA, you might consider a backdoor Roth IRA. This involves contributing to a traditional IRA and then converting those funds to a Roth IRA. This strategy can help high earners access the benefits of a Roth, but it's important to understand the tax implications before proceeding. Like any investment account, IRAs can come with fees. These might include account maintenance fees, investment management fees, or trading commissions. It's important to compare providers and understand all the costs involved, as high fees can eat into your returns over time. Look for low-cost options to maximize your savings. When you open an IRA, you'll be asked to name a beneficiary. This is the person who will inherit your account if you pass away. Naming a beneficiary ensures your money goes where you want it to and can help your heirs avoid probate. Be sure to review and update your beneficiary designations as your life circumstances change. If you're married and one spouse doesn't earn income, you can still contribute to an IRA for them. This is called a spousal IRA. It allows couples to double their retirement savings even if only one person is working. The same contribution limits apply, and you can choose between traditional and Roth IRAs for each spouse. Did you know you can open an IRA for your child if they have earned income? A custodial IRA lets you start saving for your child's retirement early, giving their money decades to grow. Both traditional and Roth IRAs are available, but Roth IRAs are often preferred for kids because of their long time horizon and tax-free growth. How your IRA is taxed in retirement depends on the type you choose. Traditional IRA withdrawals are taxed as ordinary income, while Roth IRA withdrawals are tax-free if you meet the requirements. Planning ahead can help you manage your tax bill in retirement and make the most of your savings. Your IRA withdrawals can affect how much of your Social Security benefits are taxed. Large withdrawals from a traditional IRA may increase your taxable income, potentially making more of your Social Security benefits taxable. Roth IRA withdrawals, on the other hand, don't count as taxable income, which can help you manage your overall tax situation in retirement. IRAs can play a big role in your estate plan. Naming beneficiaries ensures your assets pass directly to your heirs, avoiding probate. Roth IRAs can be especially valuable for heirs as they can inherit the account and take tax-free withdrawals. It's important to review your estate plan regularly and update your IRA beneficiaries as needed. Opening and maintaining an IRA involves some paperwork. You'll need to provide personal information, choose beneficiaries, and keep records of your contributions and withdrawals. Most providers make this process easy, especially if you open your account online. Keeping good records can help you avoid mistakes and ensure you get the tax benefits you deserve. If you're unsure about which IRA to choose or how to invest your money, a financial advisor can help. Advisors can explain the pros and cons of each account type, help you choose investments, and create a plan that fits your goals. While some advisors charge fees, their guidance can be valuable, especially if you have a complex financial situation. An IRA is just one piece of your overall retirement plan. It's important to consider all your sources of retirement income, including Social Security, pensions, and other savings. A well-rounded plan can help you achieve your goals and enjoy a comfortable retirement. Review your plan regularly and make adjustments as your needs change. Inflation can erode the value of your retirement savings over time. That's why it's important to invest your IRA funds in a way that helps your money grow faster than inflation. Stocks and other growth investments can help, but they also come with more risk. Balancing growth and safety is key to protecting your retirement nest egg. The value of your IRA can go up and down with the market. It's normal to see fluctuations, especially if you invest in stocks. The key is to stay focused on your long-term goals and avoid making emotional decisions during market swings. Diversifying your investments can help reduce risk and smooth out returns over time. If you're age 50 or older, you can make extra contributions to your IRA, known as catch-up contributions. For 2024, this means you can contribute an additional $1,000 for a total of $7,500. Catch-up contributions are a great way to boost your retirement savings as you get closer to retirement age. The Savers Credit is a special tax credit for low and moderate income workers who contribute to an IRA or other retirement plan. Depending on your income and filing status, you could get a credit worth up to $1,000, $2,000 for married couples. This credit can help offset the cost of saving for retirement and make it easier to build your nest egg. You have until the tax filing deadline, usually April 15, to make IRA contributions for the previous year. This gives you extra time to maximize your savings and take advantage of tax benefits. Be sure to mark your calendar and make contributions before the deadline to avoid missing out. If you change jobs, you don't have to leave your retirement savings behind. You can roll over your old 401 core other retirement plan into an IRA, keeping your money growing tax advantaged. This can also give you more investment choices and control over your account. You can have more than one IRA, such as a traditional and a Roth, or accounts at different providers. However, your total contributions across all IRAs can't exceed the annual limit. Having multiple accounts can help you diversify investments, but it's important to keep track of your contributions and fees. If you're self-employed, you have special IRA options like SEP and SIMPLE IRAs. These accounts let you save more for retirement and may offer tax advantages for your business. Choosing the right plan depends on your income, business structure, and how much you want to contribute each year. There's no age limit for contributing to a traditional or Roth IRA as long as you have earned income. This means you can keep saving for retirement even if you're working later in life. Continuing to contribute can help you build a bigger nest egg and enjoy a more comfortable retirement. Choosing the right IRA depends on your personal situation. If you want a tax break now and expect to be in a lower tax bracket in retirement, a traditional IRA might be best. If you prefer tax-free income later and expect to be in a higher tax bracket, consider a Roth IRA. Self-employed? Look at SEP or SIMPLE IRAs. Take time to review your options, consider your goals, and choose the account that fits your needs.